Hello everyone, welcome back to Everything Accounting. Thank you for joining us for part 1 in our series, Recording Accounting Transactions. We hope you find the presentation informative, and you will have a better understanding of how the information provided by accountants helps the users to make better decisions. In this video we will be looking at the rules governing debit and credit entries, otherwise known as the double entry system. Upon completion, you should be able to accurately record the debit and credit entries based on the different transactions the business does daily, and explain how these transactions will affect the different general ledger accounts. But before we get into that, if this is your first time checking out the channel, we would appreciate if you would consider subscribing for more content. And if you think this information was useful, why not click the like button, and don't forget to share this video with whoever you believe may need this information. So, without any further delays, let's discuss the double entry system. Now, persons might be thinking, what do I mean by the term business transactions? Examples of business transactions would include purchasing a new asset, such as a delivery van for the business, paying your creditors and collecting payments from your customers. Before a transaction can be entered into the business's accounting system, there must be some evidence that the transactions have occurred. This evidence would normally be in the form of source documents such as invoices from suppliers, signed delivery notes from customers, and movement in the balances on your bank statement. But how do we know that we are entering the results of these transactions accurately? The double entry procedure requires that for every debit entry, there should be an equal credit entry. This entry should also be equal in dollar value. Debit entries are placed on the left side of the account, while a credit entry is placed on the right. When analyzing the effects of a transaction, it is always important to refer to the accounting equation, as you will need to determine whether the transactions increase or decreases the assets, liabilities, or capital of the business. The general rule is as follows. Assets are increased by entries to the left side of the account and decreased by entries to the credit side of the account. Liabilities and capital increase with entries to the right of the account and decrease with entries to the left side of the account. Now that you understand how this process works in theory, let us try an example. Question. On January 1, 2021, the owners of Nigel Limited issue stocks valued at $10,000. How would the accountant record this transaction in the books of Nigel Limited? The first step is to figure out how the transaction will affect the different elements of the accounting equation. Whenever a transaction increases an asset, which in this case would be cash, a debit entry is made to the cash account. Whenever a transaction increases a capital, which in this case would be the capital account, a credit entry is made to that account. Hence the correct answer would be to debit cash and credit capital stock. Now it's your turn to try a few more examples on your own, and if you run into any challenges, feel free to reach out to me, and I will assist. Also look out for part 2 in our series, when we will discuss how to record transactions that changes the balances of revenue and expense accounts. Thank you for watching. See you in our next video.